Most people believe money enters the economy when governments print it. That belief is wrong. In reality, money enters the economy through a far more complex and far more powerful mechanism, one that most people never see, never question, and never fully understand. A system where money is created not by printing presses, but by balance sheets. Not by politicians, but by institutions. Not all at once, but gradually, invisibly, and conditionally. This is the story of the Federal Reserve. A story about how money actually enters the economy, and why that mechanism quietly shapes inflation, inequality, asset prices, and financial stability. The most common belief about money creation is simple. The government prints money, spends it, and inflation follows. This image of cash being printed and injected into the economy is intuitive. It is also deeply misleading. In modern economies, physical cash represents only a small fraction of total money supply. The vast majority of money exists digitally inside the banking system, created through credit expansion. The Federal Reserve does not print money in the way most people imagine. It creates the conditions under which money is created, and that distinction changes everything. The Federal Reserve is often described as America's central bank. But structurally, it is neither fully public nor fully private. It's a hybrid institution created by Congress, independent from direct political control, operating through a network of regional banks governed by appointed officials. Its mandate is officially simple: price stability, maximum employment, financial system stability. But its influence goes far beyond these words. The Federal Reserve sits at the center of the monetary system, controlling the price of money, the availability of credit, and the liquidity of financial markets. It does not decide who gets money directly. It decides how easy or difficult it is for money to be created. Here's the most important concept to understand. Most money enters the economy through lending. When a commercial bank issues a loan, it does not hand out existing deposits. It creates new money. A loan simultaneously creates an asset, the loan, a liability, a deposit. And this is how money supply expands. The Federal Reserve does not lend to households or businesses directly. Instead, it controls the conditions under which banks are willing and able to lend. That control happens through three primary channels: interest rates, reserve conditions, financial market backstops. The most visible tool of the Federal Reserve is interest rates. By setting the policy rate, Reserve influences borrowing costs, credit demand, asset valuations, risk-taking behavior. Lower rates encourage borrowing, higher rates discourage it. But interest rates do not operate evenly across the economy. They impact financial markets first, then asset prices, then corporate borrowing, and only later households and wages. And this creates a hierarchy of money entry. Money enters the economy at the top, through financial institutions and capital markets, before it reaches the broader public. Traditionally, the Federal Reserve influenced money supply through open market operations. It buys or sells government securities from primary dealers. When the Fed buys securities, reserves are credited to banks. Liquidity increases, lending capacity expands. When the Fed sells, reserves are drained. Liquidity tightens, lending slows. This mechanism doesn't inject money into people's pockets. It injects money into the banking system, allowing credit creation to expand or contract. After the 2008 financial crisis, the Federal Reserve fundamentally changed how money enters the economy. Interest rates alone were no longer sufficient, so Federal Reserve introduced large-scale asset purchases, known as quantitative easing. Through QE, Federal Reserve bought trillions in treasury bonds, purchased mortgage-backed securities, expanded its balance sheet dramatically. This injected massive liquidity into financial markets. But again, notice where the money entered. Not wages, not consumer spending, and not public infrastructure. It entered bond markets, equity markets, real estate financing, asset valuations. This is why quantitative easing stabilized markets, but also contributed to asset inflation and inequality. Money entered the economy through asset holders first. Federal Reserve cannot force banks to lend. It can only make lending more or less attractive. During periods of uncertainty, banks become risk-averse, credit tightens, money creation slows. During periods of optimism, leverage expands, credit grows, money supply increases. This is why monetary policy is asymmetric. It is far easier to inflate asset prices than to generate broad-based wage growth. The system rewards leverage, collateral, and financial access. This is not a conspiracy. It is a structural feature of how money is created. One of the most misunderstood aspects of modern money creation is who receives new money first and who receives it last. When the Federal Reserve eases financial conditions, new money does not enter the economy evenly. It flows through a specific sequence, often referred to as the monetary transmission hierarchy. Money enters first through large financial institutions, primary dealers, asset managers, capital markets. From there, it moves into equities, bonds, real estate, private credit. Only much later does it reach wages, small businesses, consumer spending. By the time money reaches households, prices have often already adjusted upward. Asset values have risen, housing costs have increased, living expenses are higher. This is why monetary easing can feel supportive for markets while simultaneously making life more expensive for ordinary people. Economists sometimes refer to this as a distributional effect of monetary policy. It is not intentional favoritism. is a consequence of how money is created through credit, collateral, and financial access. Those closest to financial markets feel stimulus first. Those dependent on wages feel inflation first. Understanding this sequence explains why. Asset owners benefit disproportionately. Inequality widens during easing cycles. Public frustration rises even when policy is supportive. One of Federal Reserve's most powerful and least understood roles is acting as lender of last resort. During crises, Federal Reserve backstops banks, supports funding markets, stabilizes liquidity, prevents cascading failures. In 2008, 2020, and again in 2022 to 2023, Federal Reserve created emergency facilities to keep markets functioning. These interventions prevent collapse, but they also teach markets an important lesson. The system will be rescued. This shapes behavior long before the next crisis. Risk-taking increases. Leverage builds. Fragility accumulates. Money enters the economy not just through lending, but through expectations of support. Another critical channel for money creation is government borrowing. When governments run deficits, they issue bonds. Those bonds are purchased by banks, asset managers, foreign institutions. When the Federal Reserve intervenes, directly or indirectly, it ensures that government debt remains fundable. This allows fiscal deficits to persist, but it also means that money creation increasingly flows through sovereign debt markets, financial intermediaries, asset-based channels. This is why modern money creation is inseparable from debt. People often ask, if Federal Reserve creates so much money, why isn't inflation always high? Because inflation depends not just on money supply, but on where the money goes. Money that circulates within financial markets inflates assets. Money that reaches wages and consumption inflates prices. For decades, globalization and demographics absorbed monetary expansion without consumer inflation. That buffer is now weakening as money creation increasingly collides with supply constraints, labor shortages, geopolitical fragmentation. Inflation becomes harder to control. The Federal Reserve is often portrayed as all-powerful. In reality, it is constrained by debt levels, financial stability, political pressure, global capital flows. Reserve does not decide outcomes, it manages trade-offs. And in a highly leveraged system, those trade-offs become sharper and riskier. Money enters the economy not through precision, but through compromise. The modern monetary system functions smoothly. Until it doesn't. Under normal conditions, Federal Reserve can influence behavior by adjusting incentives. Lower rates encourage borrowing. Higher rates restrain it. Liquidity flows predictably through markets. But there are moments when this mechanism begins to fail. This usually happens when debt levels are already high, asset prices are elevated, confidence becomes fragile, and tightening collides with financial stability. At that point, monetary policy loses precision. Rate hikes stop slowing inflation cleanly and start breaking institutions. Rate cuts stop stimulating growth and start inflating bubbles. Liquidity support becomes necessary not to encourage expansion, but simply to prevent collapse. This is when Federal Reserve transitions from economic manager to system stabilizer. Policy choices narrow. Every decision carries trade-offs. Tightening risks financial accidents. Easing risks inflation persistence. Inaction risks loss of credibility. This is not failure. It is the natural limit of a debt-based monetary system. Money creation continues, but under stress. Distribution becomes more uneven. Volatility increases. The gap between financial markets and the real economy widens. When this stage arrives, the question is no longer, how do we optimize the system? It becomes, how do we keep it functioning? Understanding how money actually enters the economy explains why asset prices rise faster than wages, why inequality widens during easing cycles, why inflation feels unpredictable, why crises keep recurring. It reveals that monetary policy is not neutral. It shapes who benefits first and who absorbs the costs later. The modern monetary system was designed to be flexible, resilient, and crisis-resistant, and in many ways it works. But it also concentrates power, amplifies cycles, and quietly redistributes risk. Money does not enter the economy equally. It enters through channels that reflect financial structure, not social fairness. The Federal Reserve does not print money the way most people imagine. It sets the conditions under which money is created, distributed, and protected. Understanding that process is not about politics, it's about clarity. Because once you understand how money actually enters the economy, many things that feel confusing suddenly make sense. If you want to understand how the global financial system actually works, not the simplified version, but the real architecture behind it, this channel breaks it down in a clear and structured way. Subscribe if you want to stay ahead of the shifts most people won't recognize until the consequences are already unavoidable.